Hey everyone, Retire on Dividends here. Back to do another interview, but this time with the one and only Jay Pestrichelli, the CEO and co-founder of Zega Financial. And he's here to yell at me about, making fun of the bad calls, the tight strike prices. No, I'm just kidding. But he was kind enough to give me some time today. And I'm going to go through some questions with him and take it from there. But for those of you who do not know Jay, if you don't mind just giving a quick intro about who you are and where you're from.
Yeah, absolutely. So great to be here, Rod. I think it's like your channel has been doing such a great job covering our funds. The detail you get into, hats off. Like you're doing a lot of stuff that we're doing in the background. So I always appreciate the good work. You're right. Maybe we'll have an active dialogue on the criticism on our call strikes. But yeah, so I am, as you said, CEO of Zega Financial. My firm is the sub-advisor for the YieldMax funds, also the Defiance funds, the option Defiance funds, and amongst others. So what does that mean to be the sub-advisor? It means we're the ones that are managing the portfolio. We're the ones deciding which options to put on, how many options to put on, when we do our roles, all of those kinds of things. That's our role. We're we basically get hired by the investment advisor, which in this case is the trust that houses all of these funds, right? So it's boring 40X stuff on the way the structure has to work, but we get to do the fun part, which is the trading.
Definitely. So the real, like I mentioned in the beginning, the question is, does Jay watch Retire on Dividends, or does Jay's fund managers watch Retire on Dividends? And do they get angry at some of the videos?
No, so nobody gets angry. By the way, yes, from time to time I watch the videos. I know one or two of my other guys watch the videos. We'll pop it on and see what you have to say when the distribution comes out or something like that. Nobody gets angry. No one's like, we may say like, wow, he doesn't know what he's talking about, but that's not the case with you. You always have a good perspective on it. And again, I think, the priority for the individual investor sometimes, may get a little skewed versus what the priority for us is as the investment manager, which is always for us, the first and foremost goal is achieving a higher distribution rate. Like we want to get those higher yields, those higher dividends, and that's our primary decision. You've always got to weigh those things, right? And so, look, sometimes we've nailed it. Sometimes, in a falling stock, we wish we rode closer. On a rising stock, we wish we went farther out of money. We, of course, are aware farther out of the money, the more upside you capture if it goes up. We totally get that. But that's secondary to the income portion. So nobody ever criticizes. Nobody goes, that guy is really not favorable. I think we appreciate the education you provide and the awareness of the funds. That to me is first and foremost here, which is why, I'm happy to be here and talk about it all today.
Definitely. Well, that's good to hear. All right. So I have, we'll get into the questions. I'll say 10 softball questions and then 10 tougher questions. So we'll go from there. So the first one, I don't know if anyone ever asked you this, but what does Jay Pestrichelli do for fun outside of options trading?
What else is there? Like, I love option trading. On the weekends, I'm looking for ways to be a better option trader. I mean,
exactly, right?
So I have a son who just went off to college, so spend as much time as I can with him. We live in Florida, so we go to the beach a lot. But yeah, all sorts of fun stuff you could do in this cockamamie state. I didn't always live here. I grew up in Jersey, lived in Nebraska for 10 years when I ran the trading business at TD Ameritrade, and then, ended up moving here because I was just sick of the cold winters. Anybody that's, in the Midwest knows Nebraska gets pretty darn cold. Minus 20-degree weeks is a real thing that happens there. So I was like,
I'm in New Jersey. Where'd you live in New Jersey?
Yeah. So just general, really, I don't have a golf, love to go shooting, stuff like that. Random, nothing really, really interesting. Sorry.
That's fine. No, where'd you live in New Jersey?
I grew up in Bergen County, little town called River Edge between Paramus and Hackensack. Most people have heard of those towns. So. Okay. My folks still have a house there.
Yeah, nice. No,
I'll go looking for them.
I'm jealous. Yeah, I'm jealous. You're in Florida. I always wanted to move there because, you're right. The winters are like, as they get older, it hurts more and more in the winters. So
yeah. Downsides, right? Hurricanes, that kind of stuff.
course. Yeah, it's super
People
hot.
from Florida.
Bugs.
I'm kidding. I do like to joke, and all my Florida friends, I say this. I say Florida would be great if it just wasn't for the people from Florida. But besides that, it'd be great.
Yeah, everyone's joining you. That's the problem. It's New Jersey, New York, Florida, right?
Oh, I know plenty of people on the West Coast listen, watch your channel. So shout out to those guys when I said that. So West Coast.
At 6:30 a.m. Eastern Standard Time, right? I gotta get up early. All right. So I know you talked about this too. You had involvement with the Thinkorswim platform. So I wanted to know, like, what exactly was your involvement with that, getting that done? And also on top of that, what do you think of the Charles Schwab merger? Because I don't know. I feel like that was I was a TD Ameritrade guy, Thinkorswim guy. They went to Charles Schwab. Thankfully, they kept Thinkorswim. Outside of that, I'm kind of disappointed. So I just wanted to get your thoughts on both.
Yeah, so we manage individual accounts on the Schwab and the former TD Ameritrade platforms. We had accounts at both. We manage about 3,000 individual accounts with our RIA business. So we're familiar with all of those platforms. I'll kind of do the answer in reverse here. I think obviously we're big fans of TD Ameritrade. 3/4 of my team is our former TD Ameritrade, right? That's where I'm from. I hired the people that I knew could do the job, right? So you'll get no argument from the people at Zega that we really did like TD Ameritrade quite a bit. It's where most of our business was. I think Schwab has just a different approach. You got to realize they're a bank, right? Like there's like the Fed basically has an office in their office, right? Like they have different regulators than TD Ameritrade had. So the way that Schwab treats options has some catching up to do. So I think they're going through some growing pains. I know a lot of people that are there, right? We talk to them all the time. They always want to make it right. I never got the, hey, sorry, Jay, it's just that's the way it is. Yeah. But, I think we find a lot of stuff with a really active manager like us, even in our separately managed accounts that we trade, they could do better. And I think they want to do better. So maybe I'll leave it at that. Things worked a little smoother for us at TD. And quite frankly, we knew that because, I was heavily involved in building that platform, right? So let's transition to the Thinkorswim acquisition. So I started with the, Ameritrade. Actually, I started with a firm called Daytech in 99, right? We merged with Ameritrade in 2002. That's when I moved to Nebraska. And then we bought TD Waterhouse in 2005. So that's where the name TD came from. So there's a little bit of history there because this matters. We were a very acquisitive firm. We bought a lot of shops because it was a great way to grow your business and consolidate on a superior tech stack. And so the Thinkorswim acquisition, I was running the trading business at that time. So that was my deal. That was my acquisition, my integration, right? So that was all kind of while I was there wearing that active trader hat. And then I left in 2010. So I think we closed that deal the end of 2008. Rough time to do anything in the market, but we closed that deal in 2008, integrated through 2009. And then I left in 2010 after that integration was kind of all set and done. So look, the platform still is one of the best trading platforms out there. I think it was a great acquisition for us when I was at Ameritrade. We had two choices. We could have built that, and it would have taken me 4 or 5 years, probably cost $100 million, or we could have bought Thinkorswim, immediately leapfrog over every one of the retail brokers from a platform and trading perspective. Yeah, it cost us, I think it was $500-600 million to do that deal, but it immediately put TD Ameritrade in a spot that was ahead of everybody else. And they haven't looked back since, right? So it was a great acquisition, and we're still happy with that. We still talk to the people at Thinkorswim.
It's good. Yeah, I love that platform. I mainly use the app. It works so well, especially, and the desktop app too.
Yeah, I'm a desktop guy. We're all desktop guys here.
Yeah. Well, I'm always like, well, I work from home sometimes, so I'm able to sometimes use it. But I saw it in a latest interview. Obviously, you were involved with a SoFi fund, I believe, THTA. You're obviously involved with YieldMax, and you're involved with Defiance. Is there any other funds that you're involved with that we may not be aware of?
So we do a little other work. There's a company, a partner of ours, Nicholas Wealth. He's got a brand X Funds. His ticker is FIAX. That is more, but It is an options-based fund over a basket of treasuries, but it is more of it's a very conservative income fund. Doesn't take a lot of risk. The primary goal there is stability and yield. I think it's yielding about 7%. So we manage that. We're a partner with him on that one. We actually have our own ETF. Zega has a buy and hedge ETF, ZHDG, Z-Hedge we call it. That was our very first ETF that we put out there. So we are, I mean, that one has our name on it. It's actually the only one with our name on it. But that one's been out there the longest. That is a hedged equity ETF. So upside capture in the market, but put a hedge in it to kind of protect against, major market sell-offs. Again, not nearly as not as much hot sauce to say YieldMax or Defiance has in that one, but it's a good core holding. We use it within our SMA business as well. Both of those two. So 2 other brands that we're involved with.
Thank you. Speaking of YieldMax, it came out, Tesla came out November 2022. I'm just curious, how long prior to that did you have this idea to make this and create this?
Yeah, so we've been running, really, it was born out of the kind of concentrated work that we do with our individuals. So for example, we'd have people walk into an advisor's office that we work with, and let's say they have $3 million of Apple, or Tesla was a really popular one in 2020, 2019, and they just wouldn't know what to do with it. We'd say, yeah, we could sell calls and generate income for you, or we could buy a put to protect it. And so we've been doing kind of that concentrated stock approach where you have a single stock as the only holding in the account since probably 2013 was probably the first where we just started doing that. Right now, it makes up about 25% of our RIA business, not YieldMax, but these individuals that just have a concentrated position, and then we'll manage the options around it. So it's a pretty significant part of our business and offering that we have. And so it was just a natural kind of progression to talk about, hey, do we think we could do this in kind of a fund wrapper where you could do weeklies as opposed to like monthlies we normally do in those other accounts, because it's just too much activity, different strikes. We've got millions of dollars in Apple, and everybody starts at a different day. Everybody has a different risk target, and everybody's got a different income target. So just putting that all together in a fund and moving to weeklies was really kind of the impetus here. So the Tesla and ARK, the actual, back testing and real testing of those started in early 2022. So we were trading them just like we trade them today based on what we had learned over the prior, 8 years.
Was it always the plan for those two to launch in the beginning, or did you want to do others and maybe they weren't approved, or was it always, Tesla's I would say. ARK is, it's not as big, but obviously it's a diversified version of it. So coming out with both, made sense. But was it always those two in the beginning?
There were actually, so when we initially filed, we filed for 5 ETFs like ARK and 10 individual tickers like Tesla. So at this point, almost, I think all of the individual names have been launched from that initial filing. Not all of the ETFs have been. Yeah. So this was always like this first group. The way the filing works is you write the prospectus, you give it to the SEC, they do the review, 75-day hold period, questions back and forth. Once everything's good, then you can seed and launch the fund. So these were always kind of believe it or not, actually, Berkshire is the only one, I think, on that initial filing that we didn't launch. And it was the original idea that Tidal had with us, right? So when Tidal, who's the trust, and we're the sub-advisor, right? When we got together and started talking about this, that was the first one that they said, like, hey, could we generate a dividend on Berk? Because Buffett doesn't pay a dividend, right? Great stock, doesn't pay dividend. Can we generate it with options? We haven't actually launched that one yet because the IV on Berkshire Hathaway is so low. It's lower than the S&P. Right. Yeah. So to have like a 4 or 5% dividend and cap the upside every week didn't make a lot of sense.
Is that what it would be? Like 5%?
Yeah, it would be really low. And so we don't think, our community would be really interested in that kind of a yield. We didn't know at first what would be interesting or not. Yeah. But at this point, we realized, look, more yield, more interest, right? That's just the way that it's linked right now. So we haven't launched it. I think all the others we have launched, but Berk was on the original list, and that one just hasn't got the love. On the ETF side, we didn't launch. We recently launched GDXY,
Yeah.
Right. That one is, I think, our most recent launch.
Yeah.
That one was on the original filing. So it took us, what are we talking, like 2 years basically to get that one live. Obviously, ARK went first. Other ones on that list were like XBI. We haven't launched that yet. TLT. Right when we filed, BlackRock filed a TLT fund.
Yeah.
TLTW.
YTLT. I see that one.
Yeah. So, and we just haven't, we thought, that's kind of a crowded space, and we didn't love the prospects of a 30-year, 20-year bond portfolio anyway. Not that we don't really make a call on the underlying, but we said, that feels like somebody else's space, but we did file for it. Trying to remember, there's one more ETF that we did not, ARK, GDX, TLT, XBI.
Airbnb was one. I wrote down all the pending ones too, because I basically, I'm just waiting. Actually, I can delete Snowflake now because they're
next week.
Next week, right?
Yep, next week. Yeah, so I think that gives you kind of the idea of what we're thinking. Like, let's go for very kind of popular stocks, right, where people might have an interest, or they might have a concentrated position. Apple wasn't all that interesting, except that it's the most widely held stock. So like, we got to do one on Apple, right? So just, we do a little market research on these things, like how popular, what's the volume, all things like, option capacity, market cap, all that kind of stuff goes into the mix. But, it's a business decision which one of these you want to launch, right? Because there's a cost to every one of these, and they have to grow, or it doesn't make sense to launch them.
Exactly. Yep. So if you had to pick, what is your number one favorite YieldMax fund as of right now?
They're all my favorite babies. I'm kidding. Look, I'll tell you, the hottest one right now is Misty, right? No doubt.
Oh, yeah.
That one is seeing the fastest growth. It has the consistent volatility, so we have the consistent dividends. It could whipsaw just like, Coney does, or what Tesla has done in the past. But so look, I guess it all depends what you're trying to achieve, right? If you look at, you want the most exciting one, Misty's definitely, Coney are definitely ones on the top of the list. NVIDIA, how do you ignore that one, right? That one's obviously been super.
Yeah, that one's, I call that the GOAT. NVIDIA's the GOAT to me.
It is. I think it's been great. But if you are someone who's more of a total return person, then you look at, AMZ and MSFO, believe it or not. And while this isn't something that we think this is not our goal, the actual covered call strategies outperform the underlying, which is rare, right? I would say you should never expect a covered call strategy to outperform the underlying stock. It's just not what it's designed to do. It's designed for income, not necessarily growth. The growth is like a bonus. But actually, those two have been great in actually outperforming their underlying. So it's just, I guess it all depends what it is you're trying to get out of them. Like I said, the hottest one right now is clearly Misty. Ulti is a lot of work for us. We like Ulti, where we want Ulti to really work. We think it's unique enough. Ulti is like a hedge fund, right? Like the amount of activity and research and trading that goes into like Ulti, it's quite extensive, right? So we've had hedge funds before that we've managed. Ulti feels like that level of effort, right? It's not one stock, roll a call, roll the synthetic. It's a lot more engaging than the others.
Yeah. You said you had, I did have a question on Ulti for later, but we have one fund manager on Ulti. His full-time job is Ulti.
It could, if somebody, all they did was trading Ulti, it would take up most of the day. Actually, there's 4 people on Ulti.
Four people on Ulti. Wow.
4 people, not all day, every minute of the day, but there's 4 people on Ulti. Yeah. Ulti's a lot of work.
Why aren't they in GameStop? They were. What happened? They're scared, or?
No, look, we did have GameStop at one point in it.
I know it was in there, and then I think Corey, a happy camper, reached out to you, right?
Yeah.
I thought because it was still there Saturday, but like you said, it takes, it doesn't officially get assigned until the weekend, and I was like, oh damn, because I saw no calls, because I made a post. I'm like, Ulti has GME, and there's no calls against it. So the upside,
you got all the upside. Oh, but it got called away Saturday, right? Because technically options expire on Saturday. So the thing about GameStop, so I won't say it'll never be in the portfolio again. It might be. It's so all of the brokers are scared of the requirement on GameStop. So even though we have a covered call and we don't really have any risk on the upside, we have the downside risk like any covered call strategy. The maintenance, the requirement that the broker has to put up is based on the assignment value of GameStop. So when we were long 15, and it was trading 76. Guess what? They had to put capital aside for $76 a share, right? So they end up charging Ulti a fee for that kind of excess maintenance pass. So it's unfortunate. There's some like, back end things that the boring part of the stock market is the clearing side of things and the maintenance side and the obligation of linking up long calls with short calls and long stock with short calls. It just gets a little onerous. So right now, while it's got all this focus on it, it's been something that our brokers have said, we wouldn't mind if you avoided this one. So, by the way, it's also really hard to get a pulse on that, right? Like, I don't know, when do you get long that thing? Is it always? No, right? We didn't want to get long at 76. That was a good call. Do I want to get long at 43 today, 34 today? Hard to make that decision, right?
Yeah.
That one's a little rolling of the dice. If
Roaring
I could hedge it.
going live. So, could be going up. I don't know. What's up? Yeah, that one's unpredictable. It is scary. That has some crazy IV that you can go way out of the money.
You totally can. And so we've thought about maybe a minor position, right? Usually we kind of equal balance across the 15, 20 holdings that we have because we're doing sector, diversification. Nothing says we can't throw a little position on it just for the, hey, we're in it right now, right? Because I think that does gain some attention. But it would only be probably more for optics than it would be for any material appreciation. We're still going to sell calls on it, right? We're still going to cap the upside.
Yeah, exactly. You got to make money.
Yeah.
Although, I don't know, that one, well, no, it's not a synthetic then. I was going to say, if it was a synthetic, you could just hold it and you're going to make premium money that way on the call.
Yeah, right? And then when you do that roll, you get all that upside. Yeah, I got you, man.
Yeah. Yep. So you recently came out with an inverse fund crash, inverse of Tesla. I'm assuming this one is not going to be included in YieldMax. And if that's the case, are you going to have, say, when you have like 4 inverse funds, are you going to have a fund of funds for the inverse funds?
Yeah. So look, when you asked what my favorite fund was, I almost said crash because it's so unique, right? No, it doesn't look like it's getting the love and attention that the bullish, covered call ETFs are getting. It's a bearish covered put strategy, right? So it's an inverse. I think it's completely unique, first of its kind in the marketplace. No one's even filed for anything like it, right? So I'm optimistic on this one, but the volume is still kind of picking up. So it's really early to say. So you are correct. Crash won't find its way into YieldMax. YieldMax's prospectus specifically calls out covered call ETFs. That's not crash. So if we filed for 6 inverses, right? Crash is just the first of them. I've had a few requests for the inverse Coney. The fiat is that ticker, right? Like a fiat currency, FIAT. Nothing to do with the car. What's that?
Who are the others?
So let's see. Fiat, the NVIDIA inverse one is chips and dips. I thought that was a pretty good one. I think that's CHPS. Apple is the other inverse one. I think that ticker is rotten, ROTN. Like we had a little fun with the inverse.
Yeah. You don't have to do the Y on those, so you can have fun.
Don't even do it. Well, because they're actually like we're running out of like the tickers are getting tight on some of these, right? Yeah. So, and that was we couldn't just get consistency. I think then we did one for the Qs. So that was kind of that was the 6. So would we eventually do like a YieldMax, inverse? Yeah, I think we could if these were popular enough. Crash just had its first distribution, and you could kind of see where that landed, actually slightly higher than Tesla. And that is a function of its structure. Like it should always have a little extra juice in it. I could go into the details why if you want to. But just to answer your question, I think if we launched more, we absolutely would do a fund of funds with it.
Okay. Yeah, I know. I know, like you said, it's not as popular as you thought, but I think shorting Tesla is scary for people in general, right? So if you think of it that way, I know there's a lot of Tesla bulls, but there's a lot of Tesla bears.
Yeah, I thought the Tesla bears would kind of come out of the woodwork and say, finally I could do a YieldMax on the other side of this one, right? And we thought because it's so polarized, I'm just looking at the volume on Crash today, right? Only 6,000 shares traded so far, so it's early, but again, not a big runner. When you look at, say, GDX, that's been even newer, GDXY, there's 55,000 shares traded on that one. So again, it's just Look, sometimes you can put out, the most innovative product that you can think of, and nobody wants it, and then that's okay. That's the way it goes.
Yeah, I know. Yeah. And plus, people have a sour taste on Tesla, maybe. Or I think the people that at least I hear are using it, they're using it as an offset to Tesla. So they're saying, all right, I'll own 70% of Tesla, 30% crash. And maybe that'll balance itself out, stay capital flat, and I'll earn a solid yield. At least that's.
Look, up until yesterday, both Crash and Tesla were outperforming Tesla since the launch of Crash. So you could find that sweet spot with, Tesla's volatility narrowing and the stock chart narrowing. You could have that sweet spot where both of those funds outperform. So it won't always happen that way, but it's nice the first month it happened that way.
Yeah, definitely. So I know we talked about the fund managers early. So I was just curious, how many, like, outside of Volti, of course, how many funds does one fund manager work on? Are they assigned to specific ones, or how does that work?
Yeah, like the structure in a trading shop is you still have a primary person watching. These are actively managed funds, right? They're not passive. It's not, I'll just hit the rebalance every day and there you go when you have creates and redeems. They have to be actively managed. New strikes have to be chosen, picked, I guess is not the right word there. So so there's always one person that's primary, but there's always two others or three others. Believe it or not, we have a meeting every day, every morning. We talk about every single fund and we talk about what the plan is for that fund, right? On that meeting, there's 6 or 7 people. So it's a daily investment committee on all 33 ETFs that we manage. Yeah. So while one person has is wearing the hat for that day, it could be anybody, right? That usually it's assigned, but look, people take off. So you can't just have somebody, the fund manager, that guy's taken off for the week and then nothing trades, right? Obviously that wouldn't make any sense. But so there's 6 of us, right? There's 4 primary guys clicking the trades, but there's 6 of us between the portfolio managers and the traders. So it's one of those things that, you could do that math, right? 8 each generally, right?
Okay. So they could, any fund manager can pick up on any fund as needed if people are out. It's not
exactly. Yeah.
Here's a question. Do you review every single transaction before they actually send it off? Or does someone
like Jay? Does Jay review every transaction?
Jay or Jay's people under him?
That wouldn't be very scalable, but every trade is absolutely confirmed, right? We have a 4 eyes, rule here, right? 2 sets of eyes on every trade, just as confirmation. And also the rules are pretty well defined internally, right? We kind of define and set our limits on that morning call every day. And so we kind of know what the trade should look like. So right now I could look at any trade and see if it meets the goal of what the day was, right? So absolutely. So, but everything gets reviewed. Yeah, for sure.
Okay. Even though I know there's pressure getting it out a certain time, right? Because, towards the end of the day, especially Fridays, I'm sure it's like, we're just under, we may,
So measure twice, cut once, right? We take that mentality.
Approve it already so I can get it done, right?
It's there's a lot of a lot of that stuff gets queued up and then you choose which ones you fire off. Like there's a lot of work here to make sure that works fairly well. Accuracy in an actively traded fund is really important.
Okay, now I have some fun, tougher questions. You ready?
Yeah.
So specifically, I want to talk about NVIDIA. So about half of the contracts were sold over earnings, right? Earnings was in the middle of the week. Maybe it was Thursday or Wednesday or Thursday. 50% of the contracts were sold 0.39% out of the money. All right. The other 50% was about 5% out of the money. So I guess, and I understand you have to hit your set goal. You have to yield a certain amount, right? So you have to hit that. But especially like over earnings, isn't there an exception where, okay, NVIDIA is on a crazy bull run. Let's go a little further out of the money, even if we have to yield a little less.
All right, so I'll do my best to answer this question. I don't remember that exact trade, but I do remember we were close on half the build. what you don't see is the time of day that we fill those trades, right? And so
Exactly.
I
Yeah.
would say I'm fairly certain we didn't sell it that close to the money when we
Yeah,
actually
that's a guesstimate based on the end of the day. Yeah.
right. You got the end of the day marks there.
Yeah.
NVIDIA, without revealing too much on the approach, really just in YieldMax in general, look, we had the synthetic that was also expiring around earnings, right? So you have to kind of take into consideration how far out in time and price. We prefer, if we can, when you have earnings around NVIDIA's, I mean, obviously there's so much extra juice, to go out the extra week to get the extra upside. But you don't want to find yourself on what's known as a short calendar spread or a short diagonal, where your short call is farther out in time than your long call. So the synthetic came into play on the expiration choice on that one. We didn't want to roll it early and realize kind of all the, the net gain or loss. We wanted to let the trade kind of run its course. So that's the level of detail that we go into when kind of picking strikes. So I would say I'd have to go back and look at the time of day on the exact trade that you're talking about. Yeah. It's not really, I mean, it wouldn't make sense to me that we would deliberately choose, 0.3% in the money right before earnings, right? I think it probably must have had a run that day from the time we rolled out of a trade and went into the new one. That's the other thing, right? Remember, whatever we had to cover the previous trade for has to go into our math, because if that was close or in the money, we got to pay up to exit. So we have to not only pay for that, but then earn our weekly, kind of covered call rate that we're trying to earn. So there's a lot of factors that go into it.
Yeah. Okay. Yeah. Sometimes I have checked that before, though, using Thinkorswim app. You're able to see based on the premium they got what time of day it was, right? So
if you
you're
put
right.
up the time and sales on that option chain, you could probably see, but you don't know which one we're going to go to. So how do you know which option chain to watch, right? But how do you know which ticker to watch? But you'll be able to see our volume go off, when it goes. You could watch the you watch the volume of the day on NVIDIA, which, expiration we're going to. You may not know which strike it is, but it's a call, right?
Yeah.
So you could kind of track the time of day if that's all you were doing. You can figure it out.
Exactly. Okay. I know there were some cases, well, there's always some cases where there's an opportunity to close out maybe the calls early in the week, Wednesday, Thursday, for example. Is that ever really considered, or is it typically you're gonna let the time value expire through Friday and just see what happens?
So absolutely, right. So we have actually targets to cover every one of those calls, right? So when we sell a call, in our mind, we already have defined what the exit price is going to be if it declines, right? So it's a percentage of what we sold the initial call for. We'll close some of them out early. We're in this weird period of low volatility that you're getting in with low vol and then it stays low vol. And so there's a little persistence there in the theta and the time value of that option. In higher volatility environments, believe it or not, it's easier to exit those early because you got more up front, right? So if I work in an extra dime on the entry, I know I could cover a dime and fine, I'll do that. But when you're already slicing it as thin as you can, you're getting closer to the money than you want to. You don't have a lot of leeway in there. You still want to get your premium, but we'll cover calls early all the time. The worthless ones are easy to see. It's 3 cents. Get out of that. ARC, by the way, that happens all the time in ARC, right? Because it's just a lower priced underlying versus say Misty, right? Misty, I think today, the time value left in the 1 day options was huge, right? So we're doing this on a Friday. So it's one of those things that we're always watching for that. Where you have to be more active, believe it or not, Rod, is the deep in the money options, right? So we don't want to get assigned the stock. Actually, the prospectus says you're not allowed to hold stock, long stock or short stock, right? So it's something we try to avoid pretty dramatically. We take efforts to do that. And so you normally won't get assigned on a call that's in the money unless there's no time value left. At that point, the person that's long the call, makes sense for them to exercise it or trade it, but they may want the stock. So it makes sense for them to give up the time value because there's none left. We will trade early on deep in the money calls that have no time value left in them. Also, not only the worthless, but also when we've made all of our time value. So It's also, we made our goal. Like, hey, we made our money. I think you posted yesterday that we rolled our Coney position. Guess what? Made our money on that thing, right? Time to roll those. So it's just one of those things that we'll absolutely watch it. It's part of the active management.
Yeah, I know. I always like when you guys close out early and you only sell calls on 50%, because then you wait, like, let's wait one more day. Let's see how it goes. I like when that happens. I know you want to use all of it to get all the premium and use all the time value, but I do like when they do that. I do see that.
Yeah, because you could get maybe a free day or so of upside appreciation before you sell your next one. Yeah. And let's say the stock drops also, right? Hey, it went down. Well, now I'm already earning premium on the call that I sold. Yeah, fine. I have to sell a new one at a lower strike, but now I'm probably going to close the first one early. So we love doing the half trick. Half trick, is that what we'll call it? That tactic where if we can only do half, we will, knowing that, you're getting some of your premium early, right? Like, we look at it always in chunks of a week, right? Because we're selling weekly options. So if I could sell, on a Wednesday, I'm still only going for next week's income, right? Which means I could probably get farther out of the money, right? To get that, even though on an annualized basis it looks less, I'm still going. Like, let's say we're just trying to make $1 on a trade. I still only need $1, right? So if it's 7 days or 5 days out, that makes a difference on where you could set that short strike. So we like looking at that. We like rolling early when we can. We think it always gives us a little bit extra advantage.
Speaking of that, let's talk about, well, I call it scattered strikes. Some people saying I'm using the wrong term, but we also love scattered strikes when you pick multiple strikes, various ranges to hit different parts. And I know sometimes that happens. Sometimes, like, I think Coney, they put all their eggs in one basket, right? They chose one strike price.
Yeah, I'm looking at it now.
Scatter the strikes, what goes into that factor? Sometimes they do it, sometimes they don't.
Yeah, sometimes we call it laddered. So you're not off with scattered. We call it laddered. So it'll depend. So two factors that can drive that. One, you'll see this a lot with Tesla. We're going for a net income for the week. Sometimes it's half of this one, half of that one, and it makes sense to break it up to get your net income, right? Sometimes that happens. There's another factor of Tesla that, we have multiple primes on that fund because it's large, right? Over 650 million. We actually split it up a little bit across multiple brokers, right? To reduce our execution risk. So there's that too. So you kind of have strikes at different places. So it's an easier way to keep track of it just operationally. Sometimes, like Misty, like if you look at Misty today, what do we got? 6, 7 strikes on Misty, right?
Yeah, you give me a lot of work with Misty.
Yeah, well, it's a lot of work for everybody, but it's the hot one, so we're happy to do it. Yeah. That is a result of new creates coming in, right? Yeah. So when we get new money coming in, we don't always use the same strike that exists because maybe it doesn't meet our rules anymore, right? There's a target that we're trying to get. So with Misty, especially because the volatility is so high, it moves so much, and our implied volatility that drives the income is high, we'll have to move the strikes based on assets coming in. So look, when we do a roll, and we'll do a roll today, we'll probably end up landing all of it into the best one at the end, but it may be 2. But when money comes in, you got to do different builds for that particular slice of money that just came in. By the way, that also happens as money goes out. Now, when you have one basket, it's easy to close it, but we'll exit the positions that were most profitable if and when we have redeems.
Yeah, the exiting, I saw you guys do a pretty good job. Then and I always say these funds work best when there's new money coming in all the time, because that way, they can continue to kind of like, make additional strikes. Like Tesla, for example, they had the new money coming in all the time in the beginning. Now it's kind of just staying put. Sometimes there's a little addition, sometimes a little decrease, but the strike price is it, right? You got to get it right or not, right?
You got to get it right. Sometimes you got to just kind of split it up a little bit, right? Yeah. And that kind of helps us get our net, combined return that we're looking for on the call income.
Yeah, Tesla's had 2 strikes for the past couple of weeks, and they've been winning their calls. So they're on the quiet side, I know it doesn't it gets a lot of hate, but it's been doing good recently.
Yeah, it's okay. But like, look at the vol on Tesla. I'm just going to look at what it is today, right? When we first launched that fund, it was 70, 80.
Yeah,
today it's
45% or something.
Yeah, I mean, I'm letting next week's, I see it a 50, 54, the week after that, 51. That's tight, right? That's tighter than what we like on that. So same thing happened with ARC. When we first were doing the trading on ARC, that vol was 90, right? Today it's 30. So that's always the a risk that people, I don't think it's always the primary thing they think about. And it's not the primary risk. The primary risk is the underlying drops, right? That's always the risk of these strategies. But you could have a declining volatility as well. Now, you could have an expanding volatility, which is what happened with NVIDIA. Like you said, it's probably the GOAT. It's been the GOAT so far.
Yeah. They've been around a long time, and they've done nothing but perform. And I know everyone's argument, oh, the underlying did better. It's like, stop comparing the two.
It's not about the underlying, right?
Yeah,
it's about the income. That's right. That's right.
But don't worry. I shut them down too on that question.
Thanks.
But oh, I want to go back real quick. You said something to avoid assignment. So I thought like the Flex exchange, the European exchange, I believe you guys trade on, there cannot be assignment. I mean, is there...
Okay, so you're right. So we use flexes for the short put, right? So in the combo, the long call short put, we will use European style flexes. Absolutely. And the number one reason we do that, not because we want to look smart, it's because we don't want the early assignment, right? European style options can only get assigned at expiration. American style options can get assigned at any time, in or out of the money. I don't know why European versus American. I don't know why that's the name difference. Has nothing to do with where the options are traded, by the way. So, so we do use that. But with the short calls that we trade pretty actively, we much prefer trading in the active market. Flexes, there's a much more complicated trading process. There's no exchange. You don't see, there is an exchange for flexes, but you don't get like real-time quotes streaming on your options montage for flexes, right? We always pick a strike that's really close to an existing strike, right? You've noticed that, I'm sure. But you still have, it's a longer process to trade. You have to go out to multiple parties, you put the trade out there, you get quotes back, you have to choose which one you want to go with. So it's a little harder. I'm not saying we'll never do, and we might try it out where we have some European style on the short calls. But the short puts, because we hold those for a few months, it's easier for us to manage those. And it's the synthetic anyway. It's 100 delta trade. It's not as risky as the timing necessary with those short calls.
And I think at least the ones I tracked, the only time I saw you get assigned once on maybe, it's like the one day I saw 100 Tesla shares. I'm like, what the heck?
It's just a random assignment.
It was so random. Because at that point, I'm like, they can't get assigned. What happened? But I guess it doesn't happen often, right?
It does, and that's because we try not to let it happen. We're pretty deliberate about that. By the way, if it happens, it means we made our money early. It's actually not a bad thing as the call seller. Like I just earned all my time value, right? I was always going to pay the intrinsic to get out of it, but that extrinsic, if let's say there was a quarter left and it gets assigned, I just made it, right? Like I earn it early. So it doesn't hurt the portfolio when it happens. It actually helps us. It's just, we're outside the prospectus. We got to fix that today, right? You can't hold it. You can't let it settle, that kind of stuff.
So what happens if the short call gets assigned? Because you don't own the shares, right? What do you have to do?
So now we're short, right? We're short the stock. We buy it back, or we'll actually exercise one of our long calls against it. Okay. Right? We could do that too. Right? So we have, you got the cash because you sold the stock. So, so we got to buy it back. And obviously in that scenario, right, we sold the stock at, a much lower price than where it's really trading, but we have the gain in the long call simultaneously. So, like I said, if it's a small amount of shares, like 100 shares, we'll just trade out of it, right? We'll probably sell a call immediately as soon as we do it. Or if it's a larger position and we have to, we think it's more efficient to just exercise the call, we'll buy it back even at a cheaper price than where we sold it, where we got assigned, I should say.
Okay. So I know, obviously, you mentioned this and you've done many interviews. I've watched a lot of them. But do you always strive to yield what the IV of the underlying is? And is that always the case? Or is that like, I know Tesla, for example, you try to, right? 48%, 50%. That's the goal yield. But is that the case on every fund?
It's the starting case. Yeah, that's our baseline. right? What's the IV? Okay, can we achieve that? Where do we have to sell the calls to get that? When we roll, are we within that range, right? Are we still going to earn our, income there? So I would say that it's not the, the only factor, but it is the number 1, 2, and 3 factor for what determines where we're selling the calls and how much income we're trying to generate.
Yeah. Okay. Yeah, because I don't know. Do you feel like this? I feel like Tesla's IV is understated. I know it's not, but I feel like it is because Tesla still at any point in time can jump up and down like crazy, right? So I know, and I get, like, I look at your calls, sometimes they have to be tighter to earn the proper, yield because there's not much going up any further. But at the same time, any week, Tesla, boom, Elon does this, boom, right? Do you feel like it's underappreciated, IV?
Yeah, same with ARC. By the way, both of those are realizing a higher volatility than the implied options indicate, right? So I think I just said it in a more complicated way. It can move out of the blue and totally skew the actual, statistical standard deviation that, you look at, which drives the option pricing any single day. So some tickers like Tesla and ARC, the underlyings, have understated volatility than what they really do realize. And maybe it's low, 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 and then it's high another week, and then it's low, low, low. It makes it harder to trade those for sure. I would say, this is what happens when you trade stuff for, a couple of years and you start to go, I wish I had more tools at my disposal. We're starting to update the way we file for these to give us more ways to deal with that kind of a phenomenon. That's probably all I could say at this point. More to come.
I didn't see, there's nothing in the prospectus that says you strive to yield what the IV is, right?
Nope.
I don't remember.
Nope. That's we didn't want to lock ourselves into that.
Okay.
But it does make sense, right? Like if we have to pick something, because otherwise we're all going, what's the chart say it's going to do? Let's try to hit this number. It becomes even more discretion than we're applying than we already have, right?
Yeah.
So picking market direction isn't necessarily, it's a reality with a covered call strategy, right? You want it to go up, so that's better, and you want to give yourself more upside capture. But we wanted to figure out what's the best way to help people understand what to expect. That seemed like the obvious answer. So when we first started, and it lines up with the activity, like it all makes sense. It's statistically lined up. We use options data. I don't have to pay attention to earnings to guess how far out of the money NVIDIA is going to go, right? That's also a fool's folly anyway. That's so hard to do. So, that's where we defaulted to. But you're right. We're not locked into that in the prospectus. What I'm talking about is look, when volatility is understated, you'd rather be long vol than short vol. And you could argue we're short volatility when you sell these calls. So there's times where I don't want to be as short. I want to have some more long exposure to volatility because it can have pops. That's what I'm talking about, that you want to give yourself, we probably need to give ourselves a few more tools in the toolbox that, we could do in the fund like we do in our SMAs and our separately managed accounts.
So I have a question on the synthetic. So when there's a huge profit on the synthetic, right? So say they're up 5, 10 more, whatever percent. I know, or at least what I'm seeing, when they have to close out a bad week, they'll typically roll the synthetic with it, kind of offset it. If not, it obviously creates a lot of income. But if there's say the weekly calls really are doing pretty good, is there a rule of thumb, like say when it's up 10%, you'll roll the synthetic, capture the income, or would you prefer to leave it till closer to the expiration? Yeah,
our preference is to leave it. I know when I listen to your posts and watch them and you say, they got crushed on this short call. I am 100% okay with when that happens. Because like you said, we're making the money on the synthetic. Hey, I maxed out this week. I couldn't make any more money than the position I put on. I love maxing out. If I could max out every single week, I'd be a happy camper, not to steal somebody else's handle there. But it's just one of those things that we don't mind. It's okay. Yes, it's more trading, and yes, we lock that in. But the reason why we do it, and I think you've nailed this really well, which is, hey, it costs $20 million to get out of that call. You don't want to just take that and then watch the stock fall on you and not lock in the gain on the underlying. It is one of the beautiful things about the synthetic build. We don't have to reduce our share count or our contract count when we do those rolls and we're in the money. If you were running and so what do I mean by that? So if you were running like a regular traditional covered call strategy, like let's say QYLD, right? They're long stock and they sell calls, right, on NASDAQ. Well, they have to sell stock to generate the cash to cover those calls that go in the money. So their notional exposure, their actual exposure to the market gets reduced. For us, we roll the same number of calls. I haven't reduced my notional exposure to the market. I have the same kind of power of earning that I had before I did the roll. So it's one of those neat little benefits of a synthetic strategy versus, say, a traditional covered call, that we don't mind doing it because I'm not really giving up much. Yes, I capped out my gains for the week. Totally get that. Would I have liked to have captured more? Yeah, but I still maxed out for the week. So for us, we go, well, we got to roll, but we maxed out. If we can do the roll and earn the income to offset the cost for the short call cover, great. We're happy with that.
You have like a bell when you roll the synthetic.
Woohoo! Yeah. Well, then we all know what that does to the distributions that month, right? Because we have
I call it the synthetic bailout, right? When the weeklies get killed, here's the synthetic bailout, right? Because
yes, I like your life preserver.
Oh, you saw that? Okay,
of course.
Yeah, that. But you know, but the income is there now, right? Which leads me to my next question, right? These synthetics, they generate a lot of income. So like Misty, for example, I think that I covered Misty from the beginning. I think the first month or so, it was $8 or so per share. Crazy, right? You guys paid out around $4 or something like that. How do you determine how much of the synthetic income you're going to pay, you know, rather than like reserve it in case something happens in the future? Obviously, if it's the end of the fiscal year, you got to pay out 90% or so what you need to. But like early on in the year, how do you determine?
That's the key point you just brought out. We know at the end of the fiscal year, we've got to pay out 90% of the capital gains that we earned, or the fund gets taxed. Nobody wants that. And we want to distribute as much as we can. Of course, that's the goal of the fund. So, while I can't tell you all of the ins and outs that go into that decision, I could tell you that that piece right there is a function of it, right? Like, we could have distributed the income from just the call selling in Misty, and then at the end of the year, boom, hit with a huge distribution.
Yeah.
You could. We absolutely could do that. A lot of funds do that. A lot of funds you see on, like, you know, the middle of December, like high yield funds, or like HYG or S-Junk, right? They'll pay out an extra dividend because they have to distribute, you know, capital gains from trading their underlyings. We would prefer to kind of dole it out over time. Like, that's always been our philosophy with YieldMax, which is why, by the way, we don't hold the dividends. We could have held them, right? You know, all the conversations and criticism we've had about NAV decay. We could not decay the NAV. It'd be fine if we held all of that covered call income. Wouldn't be a problem at all, right? We'd grow and you'd see the growth. But for us, it's more important to get the distributions out there, right? We think that's what our investing community wants. So we will, you're right, at times distribute some, not all. Look, like having a 250% distribution rate, just, by the way, 100 sounds crazy, 250 sounds crazy. It was just like, let's look, it's the first month. Let's, you know, hold it back. By the way, the holding back gets diluted, right, with growth. So you probably understand this too. So let's say, for example, in that first month, we held back 5 million of gains from the synthetic roll. We said, okay, great. We're only going to do 100 and what was the first distribution, like 120, 115% or something like that. And we held back 5 million. Well, the fund has gone from, you know, 0 to 200 million. I think we're 220 million right now. Guess what? That 5 million that we held back is now diluted, right? It's a much, much smaller piece. So we don't really ever count on banking that. We do, right? And we may not have to distribute it later. We will always have to distribute that 5 million at some point, but it'll be a smaller impact. So there are pluses and minuses to holding back the dividend, right? Nobody wants to be diluted just because the fund grew. But also you don't want to, you know, hammer the NAV and have an $8 drop in the price, you know, that causes, you know, all the other things that come along with it. So, like, I'm giving you some of the factors that kind of go into the decision, not all of them, but the first and foremost is we know we're going to have to distribute 90% of the gains by the end of the year. So we always want to include some of them when we can.
Yeah, that was a tough one to predict. I'm like, they're not paying $8. I'm like, you know,
I mean, I think it went from like 20 to 40 bucks, right? Like the price, the NAV doubled in the first month.
Oh my
right?
God, yeah.
So,
And I never bought it. I just watched it and covered it, and I watched it go. I'm like, oh, nice. But yeah, it went to 40.
I mean, it's an interesting story when you look at those numbers. And I know you hadn't. Well, you know, I'll let you keep going because I do have a point I want to bring up if you don't get to it.
You can.
So when you look at the distributions, like in a bubble, right, all by themselves, if you kind of add them up, we're coming up on like $20 for Coney and Nvidia, right? Like they launched at $20, maybe August, September, you know, things kind of go the way that they're going. We may deliver in distributions $20. So think about that, right? It's like the 1 year mark on Coney. You will have gotten back 100% of your purchase price in distributions in a year. I don't know much that does that, right? Unless you're like wildcatting oil wells and you get, you know, that's the way they pay out over time. This is a pretty unique thing. And by the way, that's, you know, you've heard me on other interviews. We always say reinvest the dividends, right? You offset the NAV decay or decline because your position stays the same, right? All that kind of good stuff. But even if you didn't, if you took the distributions, put them in your mattress, you get $20 back in your first year. Nvidia will be like a year and a half, right? If it hits August, September. That's pretty great. Misty, by the way, is tracking like 7 months.
Yeah, my Nvidia I bought in the beginning. I think I'm around 65% return. Like, so, you know, I'm almost at 100%. I got my money back. Be playing with house money. But yeah, these funds, Coney, Nvidia, Misty, they're able to do that. So is the Ramsey's, but it takes 2 years, but still.
Sure, and it's still great, right?
Yeah,
you take the flip side of like Tesla, right, which is arguably the worst performing of all of them. It stinks. The first one's the worst one. But yeah, I mean, that is going to return. You'll eventually get that, all of those distributions as well, right? We keep the 50% rate. That will kind of continue to pay off over time. And so, you know, that one, while it has actually a net negative return since we launched it, even if you're reinvesting the dividends, it's still one of those things that you're just, if your goal is to generate cash, then it's doing its job.
It's still your biggest fund, though. It's hanging on.
Not for long.
Coney and Nvidia are
neck and neck, right? Neck and neck, kind of getting up there.
Who's going to hit it first?
Look, I thought it was going to be Coney until yesterday when Nvidia took the lead as number 2. So they're close.
Someone had 1.2 million new shares. I forget which one.
Yeah, it was Nvidia yesterday.
Nvidia.
Yeah, large inflows Nvidia yesterday.
Crazy. I always wanted to ask this. What is the term? All right, when I'm assuming to calculate the current month distribution, you're using the prior declaration date up to the day prior to declaration date of that month, right? Because obviously on declaration date, you're announcing in the morning, so we can't count that day, whatever you earn. So is that pretty much how it works? The cutoff for calculating?
Yeah. So again, there's a little inside baseball on this one, and it seems like the accounting and the accountant in you is coming out on this part. I would say, like, you should think about these as monthly, right? Monthly timeframes, but we will adjust when the options don't expire. You know, like, hey, it's a Thursday and they're going to go to Friday, and then the announcement is 2 days later. We may include that week or we may not. So it's a little flexible. We have that flexibility when we're deciding what we want to do there. But in all honesty, it's generally month to month, right? It's generally the calendar month.
Okay. Yeah. So sometimes, you know, say you're announcing the Monday or the Tuesday, and obviously the Friday before, you're making a lot of money on these calls, these weekly calls. You may or may not include that in that distribution, you're saying.
That's right. That's right. Okay. And again, it'll kind of depend on the dynamic of the month and what we're set up for the next month too, right? And again, when is the synthetic expiring? Like, all those factors go into that decision.
Okay, good to know. Yeah, because I
didn't help you at all there, I know, but those are all those other factors.
You're killing me here, right?
I like keeping you guessing. You do pretty good, man. You're on for a lot of them.
This past month, and I knew it was gonna be bad. I didn't do that great, and I got reamed a little, but prior months I was doing pretty good. It's not easy, you know, because I don't cover every fund either, but I try to guess every fund. But even the ones I cover, it's not necessarily that easy.
Yeah, because
But
you have to watch what happens, intra-week on a lot of these and what we're doing on each one of the
yeah,
positions, right? So
yeah, because I make it in advance. I do it on the weekend because I'm not going to do it. I can't do that during the week because I don't have that much time.
I
But
just told you there's 6 guys doing that here, right?
yeah,
So you're doing
exactly.
a lot of work for one person on the side.
Yeah. All right. So here's a question I wanted to ask, and I think either you or Sylvia answered this in a prior interview. Can you explain the process? Because I know, like, a worry to people. What if the ETF goes away, right? What if they're not around in 5 years? What exactly is the process if you have to close, say, one of these ETFs like DISO or one of the lower, less popular ones? What is the process that you guys have to do to people getting their money back?
Yeah, so I'm going to take a stab at it because, again, I'm just the trader, not the administrator of the fund.
Yeah.
So the way, I've observed for other funds what has happened when they shut down. You notify your investors with, I think it's 30 days advance notice that, hey, on this date, we're going to be, fully distributing all the assets of the fund. And, okay, it's that day. If the ETF was trading at $20, the next day you're going to get $20 in cash per share, right? Just the assets are going to be given back. Most likely the fund has already gone to cash, right? Nobody wants to take that risk all the way into that last day and settlement and all those kinds of things. So there's a lot of inner workings with the custodians and the brokers to get everything kind of settled out. Then you just fully, apply the last amount of fees, closing out all the accounts. So it might be, slightly less than the $20. It might be $19.99. I don't know. Again, it depends how all that works. And then that just gets distributed to cash and the shares go away in your account.
Yeah. Okay.
It's a swap.
Right. I just wanted to get that out there so people hear from you.
Yeah. Again, like I said, in my case, I'm fired, right? Zayga is no longer trading that fund. So we haven't done that yet. So you never know.
Yeah. Because that's like a famous question I get. Well, are these funds going to be around in 5 to 10 years? I'm like, well, am I going to be alive in 5 to 10 years, right? Anything can happen in 5 to 10 years. Right?
Yeah, like I know a lot of folks do the math of, okay, if I hold YieldMax for the next 15 years, like I love that people are thinking that long. And I actually think these have an appropriate part in your portfolio for a long-term holding, right? They don't have to be traded vehicles. They're not leveraged. They don't have that kind of compounding decay or contango decay like a commodity fund. So they absolutely could be held for the long term. So I like that people are thinking about that. But, I don't know what the future is going to hold for these. Right now, they're obviously experiencing tremendous growth. The community, the investing community is adopting them. I get calls from advisor shops all the time. How do I get these on my platform, right? So I think there's more growth to come, but you never know, right? Hard to say what's going to happen 2 years, 5 years, 10 years down the road.
Yeah, you started a trend, man. It's popping.
Sometimes it's good to be first. I will joke, right? Like,
and you have the name, like that name, you can't beat that.
It's a good name. I can't take credit for the name. That was one of our partners that came up with the name. I thought it was great as well, which is why I was like, let's do that.
Yeah, exactly. It explains.
I think his first choice, he had another one. I think he was going to call it Monster Yield, and we're like, that might be a little too much. So you might have trademarked that one too. But
YieldMax worked. We're at the hour mark. Are you okay with a few more questions?
Sure thing.
Okay. So I was just wondering if you had a thought. This is what I was thinking of, because the way Ulti works, right? You guys have flexibility to kind of do what you want, right? Buy and sell different various high implied volatility. My thought was, what about creating a target yield fund? So say like this fund is 20%, this fund will yield 30%, this fund will yield 40%, and so on. And then one fund manager takes that and they have the flexibility to put in and out different, various underlyings to earn that 40% a year, and do what they want, essentially, the flexibility. I don't know. That was just a thought I had. I don't know what is that's like...
I think it's a good thought. It's a similar thought that we have had internally as well. Keep an eye out for filings.
Okay. Because Ulti, right? Ulti, I don't know, like when you made that, did you have a set yield in mind, or is it kind of like this is a fun fund, we should do it, right?
Yeah, it was okay. We like this flexibility. We can buy GameStop and AMC or cannabis funds, right? That we couldn't put in their own YieldMax. It just wasn't enough market cap or option volume to support it. I would say we've probably throttled back the amount of volatility we could sell, against those tickers. The approach on that one's just slightly different. Yes, yield is really important for us, but we know the risk of a covered call strategy is what? Capped upside, 100% downside, right? So we know that unlocking a little more on the upside is important. So while yield is still number one, there's so much volatility in some of these names that, we'll push to go as far out as we can to capture more of the upside while still, hitting what we would consider to be, an outsized yield, which is what happens with Ulti. So, a lot of different factors that go into that one. The long stock piece is also interesting, right? Getting assigned each week, you don't know yet, so it's a little less clarity. There's a lot of dynamics there. The fund is still fairly new. We're hoping that more and more people understand it, but it's had good growth. We see inflows pretty regularly on Ulti.
Yeah. Well, you said capped upside, all the downside. A lot of people say that. It's not all the downside, right?
Minus the premium from the call.
Exactly. Yeah.
That's correct.
I always try to tell people, because you're going to capture all the downside. Well, there's a lot of days where the ETFs beat the underlying,
like let's say that's totally right? Because that premium does reduce your downside delta, right? And then without getting too nerdy about option terms, but we'll watch that. You could have a 90 delta, 70 delta on the downside. Like you're not losing as much as the market on the downside. That is a nice thing about a covered call.
Yeah.
Still want the stock to go up generally.
Yeah, exactly. Yeah, Ulti, I consider my degenerate play because when I started options, I immediately traded GameStop, right? Bad move. But
it's face ripped off on that one, yeah.
Yeah, so I'm like, Ulti is like what I want to do, but I don't want to do, right? I don't trust myself to do. So I'd rather pay you guys to do that because it is, to me, like it's the most exciting fund you have, right? You look, every time I pull up the holdings, I'm like, oh, and I check out the IVs and some of these, oh my God, like insane holdings. And by the way, I do like that. I don't know if they're still in there, but Coney and Misty, Coin and MSDR were in there. And I was like, all right, good.
Yeah, sometimes they make the cut. Well, I'd say MicroStrategies has made the cut every week since we launched the fund. There might have been 1 week it wasn't in it. It makes the cut, right? And it's got the market cap and it's got the option volume and it's something we're familiar with. So, we tend to like to leave that in there. But it always qualifies for the rules that we have for Ulti.
Yeah, I hope they stay in there because I don't own them individually because I don't really feel comfortable, but I own them in YieldMax and I own them in Ulti.
Sure,
diversified funds, and it's like
taking a look how Ulti's doing today. The market's a little skittish. Yeah, Ulti's flat. Yeah, so
how's GameStop doing? I haven't checked.
I don't know. Actually, I don't have it on that watch list right now. I think it was halted a few times already.
Of course.
Yeah.
So I guess that was my last question. Actually, no, I'm sorry. One more question, then I'm going to ask if you have questions. When the payout comes out, on ex-dividend date and the cash goes negative, is that a big deal, or is it just replenished the next day? Like when you're in a negative cash position?
Yeah. So that's exactly right. Well, look, we have the collateral in bonds, right? So it's just a matter of selling bonds to meet that. Sometimes we have inflows that haven't settled yet, like we just talked about NVIDIA, right? So there was a lot of flows that came in.
Yeah.
So that has to settle, like things like that take place. We watch that pretty closely. We don't like having a negative cash balance because we don't want to have a margin, charge. But for a day, if we're going to rotate through that, it's fine because there's probably cash on the way, or we'll sell bonds to cover it, or we're about to do a roll on the synthetic that's going to generate the cash. So it doesn't really hurt the fund. Maybe you get a margin charge for a day or two. That's really it. We should not, I'm not saying it's never happened, but we never want to hold a debit balance for more than a few days. 1 day is usually the most we like.
Yeah. I think the most maybe I've seen is 2, but it's typically
and there was some reason, right, why we said, okay, let that go an extra day. Money's moving. We're doing the roll. It's going to generate cash. Like I'm not sure, you never know, but
you generally hope to put enough cash aside that it supports obviously the payments.
Yeah, right. So we do the math on the distribution. Like you said, you don't really know the rate until the ETF marks the NAV on that, right before the announcement. But we'll do the calculation, which you do every day, on the funds as far as how much money we've made or lost, and then what the covered calls made, what did the synthetic made, what did new money make, all that kind of goes into the works. And then so we're ready for that, and we kind of have an idea of what it'll be. But when you have a large inflow, I think Coney had a large inflow right before the dividend announcement, right? I think we had 75 creates that day, right? That's a tremendous amount of inflows that went into coin. So it's like, okay, rework the math a little bit, everybody, right? So we try to prepare the fund knowing that the distributions are coming. It's money we've made already. So don't put it in a bond, right? I mean, that's what we would do with the free cash that we made. So we may just hold it back and not put it in the short-term duration treasuries.
Okay. Yeah, I just wanted to see, that was all the questions I have for now for this interview, right? Now, do you have any questions either for me or for the community that they can obviously, I don't know if you want to check it, they can respond later in the comments.
Yeah, I don't know if I can respond to the comments. We got compliance stuff that I'll have to.
No, I mean to view the comments. Like,
by the way, absolutely. So what I see the most here is I've had questions around why did they create shares, right? Like, hey, why did you create shares? You hurt our dividend, or why'd you remove shares, right? It's actually not our choice to do that, right? It's a function of what's known as the create redeem process, where as money flows into the fund, in order to keep the NAV stable, you have to create shares to offset the inflow of assets, right? So in a vacuum, if you had $1 million fund and $100,000 came in, you'd be like, oh, cool, the NAV should go up 10%. But your underlying assets didn't, while the assets in total went up, your holdings didn't change value. So what happens is you have to then create 10% more shares to then have that keep the NAV stable. That is different than, say, closed-end funds. So there is a little difference that I think not a lot of people understand when it comes to why did they add shares? Why did they remove shares? Actually, it has nothing to do with us as the portfolio manager. It has to do with the inflows and outflows of the fund itself. And then that gets adjusted to keep the NAV stable. So I think that's a little bit of an accounting thing that I think you probably understand, but not everybody gets why the share count changes, right? It's not done to deliberately dilute or anything like that.
People get mad on YieldMax because with YieldMax, right, you own the funds and you get what you're getting paid, right? I know that's kind of put aside, we'll say, but there's a week or two where people can buy in and buy in and buy in. So right now, for example, I have an estimate based on the current shareholders. I know in a week, or I don't know, when is the estimate? When is the, I think it's next week, Wednesday or Thursday. But it's an opportunity for more people to buy in, but whatever you made, that's it, right? That's it. And
you can't increase the dividend because they already got paid. Like the cash is in that account, right? And that's what's going to get distributed. So you're right. I think the first or second month, that was pretty stark. Like that, I'll call it dilution. Really what it was, the dividend got diluted because more people bought. Now I'm just trying to look at the size of YieldMax at 200 million. It's a much, much smaller, it's almost de minimis at this point of what's
in the beginning, maybe it was a little hurtful.
I think the first 2 months, that was a real factor. By the way, it was another thing that we were concerned about. Was like, hey, should we drop the price of YieldMax when the individual holdings go ex-dividend, right? And you haven't received the cash yet. So what would happen is YieldMax, technically, before it gets paid the cash, should drop because all the NAVs dropped on all its holdings. And then when the cash comes in, it should pop right back up. We thought that would look really weird in the chart. So since we know what's coming in, we'll project the cash in the fund as the assets in the fund. So you'll see the assets in the fund, the cash go up, even though we all know the pay date hasn't happened yet, right? So little dynamics like that with the fund to fund go on there too. So I don't know if that's interesting or not to folks, but we're definitely aware of the risk.
If you drop it, obviously the ex-dividend date would have to match, right? Or else you'd be.
They would have to do it all together, right? Yeah.
So okay, no, I love YieldMax. I'm a huge fan of YieldMax, and it's performed very well. I made a video how to retire on YieldMax. It was a big hit. People are big fans of that fund. Did you have any other questions for myself or the community? And by the way, if you're still okay with it, I'll reach out to you after this, and we'll hopefully schedule a community interview, which is basically we'll take questions from, because most of my community, they're basically YieldMax people. So there'll be tons of questions.
Yeah, absolutely. Yeah, that sounds great. No other comments. And looking forward to seeing you at the exchange in a couple weeks.
Definitely sounds good. I just want to thank you again, Jay, for taking the interview. Appreciate your time. We all love your funds. Obviously, they've been a godsend to my YouTube channel since I started covering them, so I appreciate that. So again, thank you for your time, and I'll see you in 2 weeks, and I'll reach out to you separately for the next interview.
Sounds great. Thanks so much,
All right.
Rod.
Thank you. Take care.